Novo Nordisk, a market leader priced like it's in decline by value and momentum portfolio. Today we're looking at Novo Nordisk, ticker NVO. It's the Danish drug maker behind Ozempic and Wegovy. The medicine's at the center of the weight loss story, and right now it trades at a price you'd expect from a company that's running out of road. Just before we go, this audio is taken from the April 16th, 2026 research report available in the Value and Momentum Portfolio Substack archives. None of it is investment advice. Now here's the puzzle. Novo trades at about 10.5 times earnings. That's the kind of multiple the market hands a business in slow decline. But Novo isn't in decline. Its gross margins sit at 81%, and it holds 62% of the global volume in the GLP-1 market, the drug class behind that whole boom. So we've got a leader with leader-level margins, priced like a generic drug maker. That gap is the whole story. Over the next half hour, let's work through why it's there and whether it holds up. The company. A quick word on what Novo actually is, because it matters. The company was founded in 1923 and is based in Denmark. It employs more than 69,000 people and sells in around 170 countries. It makes its drugs in Denmark, the United States, France, China, and Brazil. Its focus is diabetes and obesity, plus a smaller business in rare diseases. So this isn't a single-product biotech. It's a century-old company with global reach. Keep that in mind as we go. Why now? First, the setup. The stock is down about 50% from where it sat in the middle of 2024. From its peak, around $148 in July of that year, it's down roughly 73%. That's a deep fall. But here's the thing people miss. This is not the same company it was in 2024. Over the last 18 months, Novo won approval for a once-weekly insulin called Wegovy. It launched an oral version of semaglutide, a pill. It's building its own supply chain, including a new plant in Ireland. It signed a research partnership with OpenAI, and it started selling through subscription platforms. The business has changed a lot. The stock price hasn't caught up. What broke? So why did the stock fall this far? Three things close together early in 2026. On February 4th, management put out guidance that caught the market off guard. They projected sales falling somewhere between 5 and 13% for the year. That's the first time the company has guided for an actual revenue decline. The stock dropped from around $60 to about $37. A few weeks later, a second blow. Novo's next-generation drug, CagriSema, failed to beat Eli Lilly's tirzepatide in a major trial. Analysts called it a worst case. The stock hit a new low, then a third. In March, the FDA sent a warning letter over safety reporting on Ozempic. To a lot of investors, that was strike three. On top of all that, generic versions from India are undercutting prices by 70%. And Novo has already announced 50% price cuts on Wegovy and Ozempic starting in 2027, which lowers the ceiling on what those drugs can earn. So the sell-off had real reasons behind it. This isn't a case of the market panicking over nothing. Signs of a turn. But the last few weeks have shown some signs of a turn. The FDA approved Wegovy HD, a higher dose, 7.2 milligram version, and Novo says its results are on par with Lilly's drug. Novo settled its legal fight with Hims and Hers and turned a rival into a sales partner. It got that OpenAI deal. It won approval for Wegovy, the first once-weekly insulin, and the CEO expects Medicare to start covering obesity drugs soon, which would open the door to 15 million new patients. So the picture is mixed. Plenty of bad news. But the company is fighting back. The controlled trough. Now here's the heart of the bull case. The argument is that 2026 is the bottom of a cycle, not the start of a long slide. A controlled trough. Think about what's happening this year. Novo is cutting prices, about 50% on its big drugs. Those cuts aren't yet offset by higher volume, and it's spending heavily. Capital spending peaks this year at 55 billion kroner. So you've got falling prices and peak spending hitting at the same time. That's the floor. Here's what's interesting, though. Revenue is soft, but earnings per share are holding up. Management is cutting costs faster than sales are dipping. So even through this trough, the bottom line isn't falling apart, and the cycle should turn. Around the middle of the year, Medicare opens up to 15 million patients. By 2027 and 2028, the price cuts will be fully absorbed, volume should be climbing, and the heavy spending should be winding down. When that happens, free cash flow could roughly double to somewhere around $14 to $15 billion. And that's before any new product wins. Management seems to agree. On the very same day they put out that weak guidance, they launched a $2.1 billion buyback. They started buying their own stock back at around $40. That tells you what they think it's worth. There's one more structural win worth naming. By settling with Hims and Hers, Novo turned a competitor into a distribution channel, adding self-pay patients at $149 a month with no cost to acquire them. Small on its own, but it points to the shift underway. The moat. Let's talk about the moat because it matters for whether you trust the recovery. Novo's advantage rests on three things. First, patents. The protection on semaglutide, the molecule behind Ozempic and Wegovy, runs to about 2031 or 2032 in the US and Europe. That's nearly a decade of protected cash flow. Second, manufacturing. These drugs are complex biologics, not simple pills. Novo spent $16.5 billion buying Catalent's sites to control its own supply. A competitor trying to match that would need billions of dollars and 3 to 5 years just to build the factories. Third, stickiness. Once a patient is stable on a Novo drug, doctors don't switch them without a strong reason. But the moat has weak spots, and we should be honest about them. The biggest threat isn't a failed drug, it's the government. When regulators demand a 50% price cut, those patents lose some of their value. There's also a rise in compounded copies of these drugs that took hold during shortages, and Eli Lilly has proven Novo can be beaten. Lilly has taken close to 45% of the new-to-brand obesity market because its drug shows slightly better results in trials. Newer players like Viking Therapeutics are working on even stronger drugs. Novo will likely keep losing share at the premium end. So the honest read is this. Novo is moving from a high-margin specialty company toward a high-volume one. The moat is still wide, but the water in it is getting shallower. The numbers. Let's look at the numbers because this is where the trough shows up. Revenue growth has slowed sharply. It went from nearly 48% in late 2023 down to under 1% by the end of 2025. And for 2026, management is guiding to a decline. That's the first contraction the company has ever faced. Now, earnings have actually held up better than the top line. Look at the recent quarters, and you see a string of beats, including the third quarter of last year, when earnings came in about a third ahead of estimates. So the market is pricing the future fear, not the recent performance. Margins are compressing, though. Gross margin peaked at about 85% in 2024 and fell to 81% in 2025. In that same year, sales grew 10%, but operating profit grew only 6%. That gap, profit growing slower than sales, is a warning sign. Some of it was one-time restructuring charges, but the underlying pressure is real. Now, free cash flow. This is the number the bears focus on. In 2025, free cash flow was about $10.5 billion. For 2026, it's guided down to around $7 billion. That's a big drop, and it's driven by all that factory spending. The ratio of free cash flow to net income is falling from about 0.59 to 0.45. So yes, cash conversion is getting worse this year. And here's the pattern again. Management says capital spending will decline in the coming years as the projects finish. So the cash flow squeeze should bottom in 2026 and recover after. And here's a number that cuts the other way. Even on this depressed guidance, the free cash flow yield is about 4%. On last year's numbers, it was over 6%. Both of those are at or above the company's 5-year average. So even in its worst year, you're getting a better cash yield than Novo's own history would suggest. Returns on capital. A quick word on returns because it's part of the same story. Novo is pouring roughly $60 billion a year into capital spending while it finishes the Catalent build-out. At the same time, margins are sliding. So returns on capital and on equity are both compressing. You can see it in the earnings growth. Earnings per share were growing about 72% at the end of 2023. By the end of 2025, that had slowed to 10%. Management frames 2026 as the low point for these return metrics and doesn't expect a real pickup until the heavy spending ends and Medicare volume starts to flow. So the returns picture is weak right now. The question is whether it's temporary. Price action. Let's quickly ground this in the chart. The stock recently traded around $40. Over the past year, it has ranged from a high near 94 to a low of about 34.5, which it hit in early April. Year to date, it's down roughly 55%. Right now, it's testing a long-term support floor around $35 to $40. It's still in a downward channel, but one momentum gauge, the relative strength index, is starting to turn up, which suggests the selling pressure may be easing. There's overhead resistance around $45. Breaking above that will likely take a real catalyst, not just drift. Market share. On market share, it's a split picture. Novo still leads the overall GLP-1 market with 62% of volume, but it's losing ground to Lilly in U.S. diabetes and in injectable obesity drugs. Where it's winning is the pill. Novo got there first in oral obesity treatment. The Wegovy pill passed 50,000 prescriptions a week in its first month. And outside the U.S., the obesity business grew 73% last year, with 35 new country launches. So the growth engine is shifting overseas and into pills. Valuation. Now let's get to valuation, which is really the center of this whole case. We'll come at it four ways. Start with the simple multiples. At around $41, Novo trades at 10.5 times earnings, about the same as Bristol Myers Squibb and Sanofi, companies with little growth. On enterprise value to EBITDA, it trades at about 7.5 times. That's the lowest in its peer group. And yet Novo has one of the highest operating margins in that group, at 42%. Low multiple, high margin. That combination is unusual. Second, a cleaner version of the same point. In pharma, higher margins usually earn higher valuations. They move together. Run that relationship, and a company with Novo's 42% margin should trade around 24 times EBITDA. That would put the stock near $140. Now that's the optimistic end. But even if you cut that fair multiple in half, you get about $68. Use the peer median of 12 times, and you get about 67. Even a depressed trough multiple of 10 times implies about 56. Every one of those is well above where the stock trades. Third, and the part I find most useful, the sum of the parts. Value Novo's stable, mature businesses, diabetes, insulin, rare disease, at conservative multiples, and those parts alone are worth roughly $150 billion. The whole company's enterprise value is about $182 billion. Subtract one from the other, and you're left with about $32 billion. That $32 billion is all the market is paying for everything else. The entire obesity franchise, the Wegovy pill, the whole pipeline, and nearly $19 billion of factories under construction. Put differently, the market is valuing Novo's obesity business, the leader in the fastest growing category in the drug industry, at about 4 times EBITDA. That's an industrial decline multiple on the company's best asset. Look at what you're getting for nothing under that math. The Wegovy pill, the next generation drug, Xanagamtide, which showed 22% weight loss in mid-stage trials. The liver disease program from Akero that Novo paid nearly $5 billion for last December. And those $19 billion of half-built factories. Add the conservative values up, and it's north of $50 billion the market is treating as worth zero. So at today's price, you're paying a fair price for the diabetes and rare disease businesses and getting the obesity franchise and the pill close to free. Fourth, the discounted cash flow. Novo's free cash flow grew from about $5.5 billion in 2021 to $10.5 billion in 2025. That's roughly 18% a year. Build a base case where 2026 is the trough at $7 billion, spending normalizes, Medicare ramps, and cash flow recovers to about $14 billion by 2028. Use a discount rate of 8%. That gives you a fair value around $61. The bear case, where nothing recovers, gives you about 20. The bull case, where the pipeline delivers, gives you about 109. And here's the most revealing exercise of all: the reverse discounted cash flow. Instead of guessing the value, you start with today's price and ask, what growth is the market actually pricing in? The answer is striking. From the depressed 2026 base, today's price implies free cash flow grows about 7.5% a year. From last year's actual number, it implies just 1.5% a year. Remember, this company has grown cash flow at 18% over 5 years. 1.5% is below inflation. It's the rate you'd assign to a utility with nothing left in the tank. And here's the kicker. Capital spending alone tells the story. If spending just falls from about $10 billion to $5 billion by 2029, which management has already signaled, that move by itself adds $5 billion to free cash flow. That's a jump of over 100% with zero help from new drugs. So the market's implied growth could be cleared by the spending cut alone. That's the core of the argument. To justify today's price, you have to believe one of two things. Either spending never normalizes, or the GLP-1 market collapses. Neither matches management's guidance or what's happening in the market. Pull the four methods together and they bracket nicely. The sum of the parts says about $81. The regression midpoint, about 67. The discounted cash flow base, about 61. Blend them and you land near 70. Against a price of about 41, that's a margin of safety of roughly a third. The Monte Carlo. To test the range of outcomes, the analysis ran a simulation. 10,000 different paths, each varying the cash flow, the growth rate, and the discount rate. The results lean to the upside. The average outcome lands around $68, about 67% above today's price. The median is lower, around 44, because a handful of very strong scenarios pull the average up. Today's price sits near the 46th percentile, which means more than half the simulated paths end up higher than where the stock trades now. It's not all upside. About 18% of the paths land below $20. Those are the cases where high rates and weak growth combine into a permanent impairment. That's the real risk, and it's the one the market is fixated on. But the shape of it favors the buyer. The downside is bounded. The upside runs much further. About 17% of the paths reach $120 or more. The market is pricing this like a coin flip. The simulation says the rewards are more open-ended than the risks. Where Wall Street stands. Wall Street has cooled on the stock. Back in January, the firm CICC started coverage with a buy and a target of $73.50. Then the February guidance hit. JP Morgan moved to a hold. Goldman Sachs moved to a hold too and cut its target from $63 all the way to $41, which is almost exactly where the stock trades now. There's a point worth making here. Those downgrades came before the Wegovy HD approval, before the Hims and Hers deal, before the OpenAI partnership. So those models may be stale, built on the bad news and not the developments that came after. Catalysts to watch. So what could move the stock? 3 things stand out. The first and the biggest is the Capital Markets Day in London on September 21st. This is where management presents its multi-year plan. It's the first time investors will see formal numbers for the cash flow recovery and the Medicare ramp. Right now, the big institutional models are running blind. A credible presentation here could re-rate the stock 20 to 30% in a single day. The second is Medicare. Coverage is set to expand around the middle of the year, opening the door to 15 million patients. Run the math conservatively. Even a 5% take-up at $500 of net revenue per patient adds around $375 million a year. And that builds through 2027. Management has said to expect a small benefit this year and the real lift the year after. The third is the pace of the Wegovy pill. 50,000 prescriptions a week by week 3. 170,000 patients in the first month. If weekly scripts climb toward 300,000 or 400,000 by the third quarter, that's hard for the market to ignore. The August earnings call is the first full quarter of data. Beyond those three, there's a supporting cast. The once-weekly insulin, a weekly, opens a new diabetes segment. The new subscription program, through partners like Roe and Weight Watchers, should improve how long patients stay on treatment. And the deeper pipeline, Zanigamtide and obesity, plus rare disease readouts later this year, gives the company more shots on goal. None of these is in the price. The risks. Now let's be fair to the other side because the risks here are real. There are three that matter most. First, that same capital markets day. It cuts both ways. If management shows up with a vague plan and no clear numbers, institutions may stay on the sidelines. That alone could trap the stock between $40 and $50 no matter how the business performs. Second, the price war. The analysis puts a 30% chance it's worse than guided. If Eli Lilly cuts prices to defend its share, and net pricing falls faster than volume grows, the whole cash flow recovery could break. This one is dangerous because it moves slowly and is hard to spot until the damage is done. Third, the CagriSema outcome. There's a 40% chance it fails. It already missed once against Lilly's drug. The next readout, in 2027, is essentially its last shot. Without a next-generation molecule, Novo risks becoming a one-drug story. It helps to put rough odds on the bigger threats. A reversal of the Medicare plan, about 1 in 5. Lilly's pill taking over the oral market, about 1 in 4. A heavy tariff on Danish drug imports, about 1 in 5. The price war deepening, about 1 in 3. The whole base case, fair value somewhere between $44 and $68, carries roughly a 55% probability. It breaks if 2 or more of those risks land at the same time. And there's a tail risk worth naming, a permanent impairment that takes the stock to $8 to $15. The odds are low, around 5%, because it would take 4 disasters at once. Heavy tariffs on Danish drugs, Medicare defunded, generic semaglutide fast-tracked, and the FDA escalating its warning into an import ban. Unlikely, but given the policy environment, not impossible. Bottom line. So where does this land? The call is a buy with accumulation on weakness. The reasoning is straightforward. The market has priced in the bad news almost perfectly. The price cuts, the spending peak, the CagriSema miss, the competition. And it has assigned almost no value to the things that could go right. Medicare, the pill, the high-dose version, the pipeline, and that September re-rating event. The targets line up like this. A base case fair value around $70, a 12-month target of $68. That's roughly 67% above today's price. The entry zone is the mid-30s to about $41, and an exit, a stop around $32, about 20% below where it trades. The one honest caveat is timing. Until free cash flow visibly recovers, and the earliest sign of that is late this year, the stock may not have a clear reason to re-rate. So this is a setup that rewards patience, not a quick trade. At around $41, you're buying a company with 81% gross margins and the leading share in the fastest growing drug class at a multiple the market reserves for businesses in decline. You're paying for the mature business and getting the growth engine close to free. The risks are real, and we've named them, but the math is skewed to the upside. That's our look at Novo Nordisk. If you want the full written work, the segment-by-segment valuation, the discounted cash flow, and the Monte Carlo detail, it's in the deep dive over at the Value and Momentum portfolio. A quick reminder before we go, this is for information only. It is not investment advice. Do your own work before you act on any of it. Thanks for listening.